Welcome back. You're watching The Money Show, and it's time for our special segment, which is Save Your Tax. And today we are going to talk about PPF and ELSS, and how can you plan your tax-saving investment via these investment options, and how can you align them with your financial goals. Let's elaborate more on this. I have with me Parizad Sirwalla, Partner Tax National Leader, Global Mobility Service, KPMG. Parizad, good evening and welcome to the show. So Parizad will be talking about PF and investing in PPF and ELSS as your tax saving instrument. Okay, both are very different from each other, looking at the underlying equation that they have in terms of investment. ELSS give you an option to put money in equity market, whereas PPF is a completely debt oriented investment. But having said that, let's discuss the tax treatment and tax benefit that you get once you invest in it. So first, let's go with PPF.
Okay, so Public Provident Fund and ELSS is what we are discussing. Thank you for having me over and good evening to all. Of course, when one evaluates any kind of investment, whether equity or debt, it's not just from a taxation perspective, needless to say. Just a caveat that there is a lot of other things, risk, return, liquidity, and your own investment objectives as an individuals. But if I were to focus as a tax person only on the tax implications of both these instruments, let me start with Public Provident Fund. We are all aware that for individual taxpayers for the last couple of years, there is an option, to go under the old tax regime, which has higher tax rates, but more sort of tax exemptions and deductions, and the new tax regime that the government has introduced, which has lower tax rates, but sort of, no deductions or devoid of any deductions and exemptions. All these tax deductions and exemptions become relevant or assume significance if you're still opting for the old tax regime, just to start with that. If I were to start with Public Provident Fund, it largely follows an exempt mechanism. And what do I mean by that? Is that any original, any money that you contribute to a public provident fund, basically under Section 80C of the Income Tax Act, as you may be aware, there is an annual deduction along with all other expenses that are clubbed there to the extent of 1.5 lakh, rupees. So the contribution sort of, you get a deduction there. The interest that you earn on the Public Provident Fund is also exempt from tax. And this is irrespective of whatever regime you are, whether the old regime or the new regime. The precise section for exemption of the interest for PPF is 10 subsection 11. And of course, then, as and when you withdraw the Public Provident Fund as well, at that time also there is an exemption, from the income tax. So PPF is basically, these are the tax implications. And your other question was on equity-linked, savings scheme, which is largely in the nature of a mutual fund scheme that primarily is investing in equity. If I look at it from a tax perspective, again, the income that you earn, first of all, even the initial investment made under the ELSS scheme, even that gets clubbed. All this gets clubbed under the 1,50,000 annual limit under Section 80C. If you are an individual who is opting for the old tax regime. Any accretion of income that you earn in the ELSS scheme, that is taxable in your hands as your normal income at your normal slab rates, whichever slab rate taxation tax rate that otherwise would be applicable to you. And on maturity of an ELSS, that would be subject to tax as investment income or as capital gains without indexation. And, as you know, for ELSS, any capital gains in excess of 1 lakh, is taxable as 10% as capital gains, and applicable surcharge will be capped at 15%. And over and above that, there will be a cess of 4% as well. So largely, this is how, the taxation of ELSS works as well. And I've already told you on PPF.
Right. Parizad, just last question to you. We can have both of these investment instruments and both you can claim benefit as per ATC?
The initial investment that you make, ATC is only for the initial amount that you pay, okay, which gets clubbed under 1,50,000, along with all your other payments that you otherwise qualify under ATC.
All right, and needless to say that once you are enrolled with your old tax regime, it's only then you get the benefit of these investment instrument as
That's
per
right.
ATC. The new
That's
tax regime doesn't have PPF and ELSS, right? Parizad, if I'm not wrong.
the new tax regime doesn't have the Section 80C deduction
Sure. Yeah.
because
Yeah.
that's the intent of the new tax regime.
All right, Parizad, that will be all. Thank you so much for being on the show today and helping our viewers with this very crucial time of investment. Thank you. And on that note, it's a wrap even on the Money Show. But then, in case you also want any help in your tax planning, do send across your questions on our WhatsApp number and email ID, and we will get it answered by our expert live. Goodbye.